E 8.15. On May 2nd, Ling Limited lends 9,000 to Chen Incorporation, issuing a 6-month 7% note. At the maturity date, November 2nd, Chen indicates that it cannot pay. Okay, so when it says that it indicates that it cannot pay, it means that you dishonor the note. So in this case, you're going to have you as a company, Ling Limited as a company, has two options. You can either assume that the person is going to pay you in the future, so here expects collection in the future, or you can probably just give up and think that this customer might not pay you in the future, which is this part over here. Ling does not expect collection in the future. So for these types of examples, you're going to have different entries. So let's see. The first one, prepare the entry to record the issuance of the note. This one is easy, right? We just have to record that we received the note. So we lent 9,000 cash, so cash has to go down, and we received a note, so notes receivable has to go up, and that's why we have an entry like this, and the value is 9,000. B. Prepare the entry to record the dishonor of the note, assuming that Ling expects collection in the future. Well, if you expect that collection is going to occur on the future, that means that you think that your customer is going to owe you this money, right? So you're going to transfer this amount to what? Accounts receivable, right? Because you believe that you have this money to be received from your customer. So we're gonna have accounts receivable like that. I forgot the dates. This is May 2nd and this is November 2nd. Okay. And we're also going to have notes receivable going down, right? So over here, we're going to have notes receivable. Now, you might be wondering, in this space over here, aren't we supposed to have two types of interest revenue and interest receivable? Well, in this case, not necessarily, because I'm going to make a timeline for you here. The note was signed on May 2nd. We don't have the year, but let's say that it is 2020. And it is a 6-month note, which means that it's going to go until when? November 2nd of 2020. Every time we have accrued interest, you're going to say, here you're going to have an option saying the company accrues interest on December 31st, for example. That means that from May 1st until November 2nd, the company over here, somewhere over here, would accrue the interest on December 31st. Right? And because it accrues the interest, it separates the interest. That's why we would have two types of interest. We would have the interest revenue and the interest receivable. In this case, since there's no accrued interest, if the customer actually paid us, we would just receive the full amount, right? And this would be what? This would be the revenue that I would get from lending money to my customer. So this would be interest revenue. The original amount of the note was 9,000. The revenue we have to calculate 9,000 times, what was the percentage? It was 7%. 7% times 6 divided by 12. Again, you see, even though the note, it is a 6-month note, we're still going to have 12 here because this number does not change. Okay, that is 315. Adding these numbers up, we're going to have accounts receivable of 9,315. C. Prepare the entry to record the dishonor of the note, assuming that Ling does not expect collection in the future. Well, for this one, we always debit accounts receivable because we think that this customer is going to pay us in the future. It's just that the customer does not have this money right now. But in the future, somewhere in the future, you're going to receive this money. But if you do not expect collection, this is exactly the definition of writing off an account, right? It's kind of like I'll say, okay, I give up. I know that this person is not going to give me my money anymore. So you have to write off. So here, we're going to have the write off entry. And what is the write-off entry? Well, we always debit allowance for, right? Not off. Allowance for doubtful accounts. And what are we going to credit? We're going to credit accounts receivable because originally this money was supposed to be paid to me. Originally, I was supposed to receive this money, right? But I'm not going to receive anymore. And since accounts receivable is a debit balance, which means that it is a plus and a minus, the increases happen here. That's why it is a debit balance. If it is in this position over here, it is a minus. So I am deducting this accounts receivable. And the allowance for doubtful accounts, that is because allowance for doubtful accounts, it is a credit balance, which means that it is a plus. I'm sorry, it is a minus and a plus, and the increases happen on the credit side. In this position over here, it is a minus, right? Okay, so why is that a minus? Why am I debiting allowance for doubtful accounts? Because allowance is kind of like a money that you keep in order for you to use somewhere, right? So we originally had this allowance that we are going to use exactly for to like pay those people that are not gonna pay us, right? We're gonna use this money, so that's why we have to deduct this allowance, because this case is a case that the person is not going to pay me anymore. So I'm going to deduct this allowance that I had for these doubtful accounts like this. And over here, we're gonna have just 9,000. Why is that? Because if the person is not going to pay me, that means that I cannot have interest. I only have interest if the person pays me, right? And pays me the full amount. That's why I would have the original amount plus the interest, and this would be the total amount. But in this case, the person is not going to pay me, so I cannot have interest somewhere here on the middle.